What if the world's oil demand isn't peaking anytime soon? Chevron's top executive, Mike Wirth, is making bold claims that challenge the International Energy Agency's, IEA, widely publicized forecasts. In a recent sit-down with the New York Times, Wirth laid out Chevron's dual strategy, expanding traditional fossil fuel operations while aggressively investing in low-carbon innovations. This stance directly counters the IEA's prediction that global oil demand will hit a ceiling by 2030. But here's where the debate heats up. Wirth argues that even if demand stabilizes, the energy sector will still need new investments to compensate for the natural decline of aging oil fields. "We don't create demand, we meet demand," he emphasized, framing Chevron's role as a provider of affordable, reliable energy for a world still reliant on hydrocarbons. And this is the part most people overlook. Chevron is already pumping a record 3.4 million barrels of oil per day, a testament to the current scale of global energy needs. Despite the industry's downward price pressures from oversupply and slowing demand, Chevron is doubling down. The company plans to invest $10 billion in low-carbon ventures like hydrogen, carbon capture, lithium, and renewable fuels between 2021 and 2028. "We have to serve today's economy while building tomorrow's solutions," Wirth explained, acknowledging the delicate balance between profit and progress. This strategy follows a seismic shift in Chevron's corporate landscape, the $53 billion acquisition of Hess, which gave Chevron a major stake in Guyana's Stabroek Block, a gold mine of untapped oil reserves. Meanwhile, the company recently relocated its headquarters from California to Texas, a move Wirth says reflects adaptability, not a rejection of environmental values. "Our culture is defined by our principles, not our address," he noted. But the challenges don't stop there. Chevron plans to cut up to 20% of its workforce by 2026, a painful but necessary step to stay competitive in a volatile market. Wirth also praised the Trump administration's resumption of offshore drilling leases in the Gulf of Mexico, calling it a win for the industry. Now here's a question to spark your thoughts. Is Chevron's strategy a pragmatic response to today's energy realities? Or is it a risky bet against the inevitable shift to renewables? Critics might argue that clinging to fossil fuels ignores the urgency of climate action, while supporters could see it as a realistic bridge to a greener future. Where do you stand? Share your take in the comments below. By Michael Kern for oilprice.com.